Accounting for depreciation, question number 2 from Singar Academy material. 3 assets were purchased here. One is for 1 lakh, another one is for 50, another one is for 2 lakhs. The date of purchase is also given here. On 1/10/2011, the asset purchased on 1/1/2010 was sold for rupees 70,000. The rate of depreciation of the above asset being 10%, and you have to follow the straight line method also in this illustration. Straight line method. Prepare asset account under different methods of accounting for the treatment of depreciation. In this illustration, I am going to follow accumulated depreciation account, or otherwise it will be named as provision for depreciation model. Provision for depreciation. Whatever the depreciation, it could be transferable to the provision for depreciation where it is going to be accumulated. On sale of the assets, asset is also going to be discarded, and accumulated depreciation on that asset up to the date of sale should also be discarded. Right. Let me solve this illustration. On 1/1/2010, the asset purchased for rupees 1 lakh. The asset purchased for rupees 1 lakh. 1/1/2010. 1/1/2010. What is the journal entry for purchasing of the asset? Yeah, asset account debit. Asset account debit to bank. Asset account debit to bank. Okay. The value being 1 lakh. The value being 1 lakh. Happy seeing your comments also. Keep posting your comments also. And I assume that the year end being 31st of December of every year. So the first year gets over on 31st of December 2010. There is no any other purchases or any other sales in that year. By default, in the year end, we have to create the depreciation. Usually the depreciation is going to be adjusted from the assets account, but here I am going to accumulate that in the new account called provision for depreciation. So for that, the entry being at the time of year end 31/12/2010, the depreciation here being depreciation account debit for the 1 lakh. 1 full year's depreciation at the rate of 10% is going to be provided. 10,000 rupees. That amount is going to be adjusted only in which account? Accumulated in provision for depreciation account. This value being 10,000. This value being 10,000. By the same time, the depreciation should be transferable to the profit and loss account. So, profit and loss account debit to depreciation. That value being 10,000. That value being 10,000. This one is over. Now I have to move on to the next year, 2011. In 2011, one more asset purchased on 1/10/2011. Between 1st January 2011 to 31st March 2011, we have purchased one more asset. And on the same date, 1/10/2011, the asset purchased on 1/1/2010 was sold for ₹70. So we have to understand how to incorporate these two items, right? One purchases as on the same date, one sale is also there. So I am going to incorporate those two. Right. 1/10/2011. Now, for the year 2011, the purchase happens on 1/10/11, right? So 1/10/11 purchase happens. The journal entry for the purchases here being asset account debit, to bank. The value being the second asset purchased for how much? 50,000 rupees. On the same time, one more asset was sold. That asset was originally purchased on this date. Whenever any asset purchased means sold, you have to provide the depreciation of that asset up to the date of sale. So this asset is going to be sold, right? For this asset, we have provided the depreciation up to 31st December only. So from 31st December 2010 to the date of sale 1/10/11, we have to again provide the depreciation. So for that, first we need to pass the entry depreciation account debit to provision for depreciation. 1 lakh is the value of the asset. Rate of depreciation being 10% under the SLM method, and period for which the depreciation will be adjusted in this current year is only 9 months. From 1st January to 1st October, only 9 months is there. So you have to create the depreciation for 9 months, so 9 by 12. Now the value being 7,500. Am I right? Yes or no? Now we have to sell this asset. On sale, where the provision for depreciation model is adapted, okay, where the provision for depreciation model is adapted, the asset should also be closed, and provision for depreciation on asset sold should also be closed, both. So here the entry being, I am getting the money as in the date because of the sale, so debit the bank account. How much I am getting here because of, say, purchasing selling the new asset. So old means the asset purchased on 1st January 2010, 70,000 rupees. So I am getting 70,000 rupees. 70,000 rupees. Two asset. What is the value of the asset? The value of assets being 1 lakh. Always it should be recorded at its own original value, because depreciation is not adjusted in the asset account. That is adjusted only or accumulated only in the provision for depreciation. On sale, any provision for depreciation for the sold asset is available there. Hereafter not required should also be closed. The provision for depreciation will always be in credit sign. On sale, it should be now debited, so I am going to debit it. So provision for depreciation. How much is that provision? In the very first year, we have provided depreciation for that asset being 10,000. In the second year, after the date of sale, another 7,500 is created. So 17,500 will be the accumulated depreciation on an asset sold, should also be now adjusted here. 17,500. Now it should tally. If it is not so, then it will be either named as profit or loss. In this case, debit side we have 87,500, but in the credit side asset is 1 lakh. From this it is very clear there is a loss. Loss is how much? 12,500. So the 12,500 is a balancing figure. 1 lakh rupees worth asset. As on the date of sale, accumulated depreciation on that asset is 17,500, because it is used for 1 3/4 year. In the very first year, we have depreciated up to 10,000 rupees. In the second year only we have used 3/4 period. For the 3/4 period, 7,500. So 10 plus 7,500, 17,500 is the depreciation provided on the asset sold up to the date of sale. That amount is available in the provision for depreciation. No more required can be transferable on sale. So the amount collected for the asset sold being 70, and provision for adjusting the loss is 17,500. So 87,500. But as per the book value, the asset showed a value of 1 lakh. So 1 lakh with worth asset after the depreciation is now 82,500, sold for only 70. So we are getting 12,500 rupees less than that. 12,500 is loss. The loss can be simply debited to the profit and loss account, or simply name this as being loss on sale. If it is being loss on sale, and automatically it should be transferable to the P&L account by the period end. On the same date, okay, so we have purchased one asset and we sold another asset. So we have completed both. Now for the year end being 31st December 2011. For the year end, again we have to provide the depreciation for the assets. Now we have, as such, now we have two assets. One asset is for 1 lakh. Another asset is also purchased in the current year, which is 50. Where this asset is sold, now we left with only one asset, 50,000. That too, this asset purchased only on 1/10/2011. So as on 31st/12/2011, the newly purchased asset is used for only 3 months. So for this 50,000 rupees worth assets, we are eligible for claiming the depreciation to the extent of 3 months only, 1/4. Let's see here the entry for this being depreciation account debit to as provision for depreciation. The value being 50,000 into 10% into how many months we have to create the depreciation? Only 3 months. So for 3 months, okay, 1250. Am I right? Are you able to get this one or not? Keep posting your answers. 1250. Then we'll now move on to the next year. Before that, so whatever the depreciation is there, nominal account should be transferred to the P&L account. So the entry being P&L account debit, P&L account debit to depreciation, the value being 1250, and not 1250. We have 1250 for a newly purchased asset. Apart from that, another asset which was sold on 1st October 2011, for that also we have created depreciation up to the date of sale being 7500. So you add these two, which is 8750. And while selling the asset, we faced a loss. That loss should also be transferred to the P&L account. So the entry being to loss on sale. Loss on sale. This value being 12,500. The overall amount debited to the P&L account with respect to the asset being depreciation of the two assets as well as loss on sale of one of the assets. Then the overall value being 21,250. Am I right? Yeah, come on. Keep posting your answers also to verify the calculation error if any. Now the third asset purchased on 1/1/2012. 1/1/2012 we have purchased one more asset. So the entry being in 2012. 1/1/2012 one more new asset is purchased. Bank account debit to asset. How much is that? Purchased for how much? 2 lakhs. First asset purchased in 2010, second asset purchased in 2011, third asset purchased in 2012 in the beginning itself. So value being 2 lakhs. Oh, okay. Asset account debit to bank. Sorry. Asset account debit to bank. So asset account debit to bank. This value here being 2 lakhs. And in that year end, 31st December 2012, we have to provide the depreciation for both the assets we have. So the depreciation entry here being depreciation account debit to provision for depreciation. We have two assets. One asset being 50,000 worth, another asset being 2 lakhs worth. Original cost. As we are going to create the depreciation of the original cost of 50 plus 200, and on that you have to create the rate of 10%, 25 and 25. And that depreciation will be transferred to the P&L account. Entry for that being P&L account debit to depreciation account. The value being 25,000. 25,000. Okay. Now, not only passing the journal entry, we better prepare the ledger also. I am going to post these things into the ledger account. So I am opening the assets account as well as provision for depreciation account. And if you want to open the depreciation account, you can open, but there is no any big issue in that. So you always create the depreciation. Immediately that depreciation is charged to the P&L account. So we don't have any balances in the case of depreciation account year on year. Asset account 1/1/10, asset account debit to bank. Okay, to bank. 1/1/2010 to bank. The value being 1 lakh. In the very first year, we don't do any adjustment, so it remains as a balance. That remains as balance for the year end 31/12/2010 by balance. That remains as it is, the value being 1 lakh. I start this as a new balance for the next year on 1/1/11 to bank. Okay, to bank. This value being 10,000. Sorry, 1 lakh. 1 lakh. And in the year 2011, What are the transactions we have with respect to the assets? One more asset purchased on 1/10/11, right? That will increase the balance of the asset. So asset account debit to bank, this value being 50,000. On the same time, we sell the assets 1 lakh. 1 lakh should be in the credit side. While posting this value in the credit side, all the opposite items should be posted. 1/10/11 depreciation, loss on sale. Loss on sale 12,500. Loss on sale 12,500. Collection 70,000 rupees. And accumulated depreciation on the assets sold is transferable from the provision for depreciation to this value being provision for depreciation, this value being 17,500. And in 2011 year end, we create one more means that's all, right? Yeah, of course, no more impact will be there in assets account, so I will be closing this. 1.5 lakhs, 1.5 lakhs. I get the balance carried on here. The balance carried on here should be 50. And by default, the next year, 1/1/2012, balance, this is not bank balance, stand corrected. Balance brought down being 50. In the last year, in the very beginning itself, we purchased one more asset for rupees 2 lakhs on the same date, in the very first year itself. Asset account debit to bank, the value being 2 lakhs. The value being 2 lakhs. Is that okay? No more adjustments is there, so you can finish off tallying this 2.5 lakhs. Year on year, we have posted all these things. Okay. By the third year end, 31st December 2012, by balance carried on being 2.5 lakhs. Start this as opening balance the next year, 1/1/13, balance brought down, the value being 2.5 lakhs. The next account we supposed to open here is provision for depreciation account. Provision for depreciation account. In the very first year end, we have the provision for depreciation. Okay, so how do I now pass the entry here? On 31/12/2010, provision for depreciation 10,000 should be in the credit side. Okay, by depreciation 31/12/10, by depreciation, the value being 10,000. That's all in the very first year. So finish up tallying this. I tallied this, and in that year 31/12/10, balance carried on also being the same 10,000, transfer to the next year beginning 1st January 2011, balance brought down 10,000 rupees. And in the next year also, we have created another depreciation. So here, depreciation on which date? The date of creating the new depreciation for the next year being 1/10/11, as on the date one of the assets sold. So depreciation account debit to provision for depreciation, the value being 7,500. On the same date that asset was sold, no. If any asset sold, any provision for depreciation on the asset sold is no more required, should be transferable from the provision for depreciation to asset account. Here that will be on which date? 1/10/11. Transfer that to asset account, the value being 17,500. The asset purchased on 1/1/2010 is sold on as on this date. For their assets, we have 1 3/4 years depreciation, which is 17,500. It's no more required. Transfer from the asset account debit to asset account to transfer to asset account, right? So here it is. Transfer from here to here. Make a note of it. And the year end, we again create one more depreciation. 31, 12, 11 depreciation, this value being 1250. 1250. This year is over. Now finish up tallying this. The value being 18,750. 18,750 on the year end. 31, 12, 2011 depreciation balance. Depreciation balance or balance carried on. Balance carried on 1250. Transfer to the next year 1/1/2012. Balance brought down 1250. In the last year 2012, again we have created a depreciation to be charged here. The depreciation created being 31/12/2012. Depreciation, the value being 25,000. Now close this. 26,250 becomes the balancing figure as on 31/12/2012. Balance brought down 26,250. Is that okay? If you open the depreciation account, this will be in the debit side, and parallelly the same will be credit side will also appear as a by P&L account. It will be automatically eliminated. So year on year we don't have any balances in depreciation. It will be automatically tallied. You no need to worry about that. So now I have explained you in the under provision for depreciation method to solve the same illustration. Come on, make a note of it.